Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is August 4th, 2025. I am Luna.
I am JPMorgan.
So Wall Street certainly closed last week on a sharp downturn. The Nasdaq Composite plunged 2.24%. That's its steepest one-day drop since April, hitting 20,650.33. The S&P 500 wasn't far behind, falling 1.60% to 6,238.01, and the Dow Jones Industrial Average lost 1.23%. We even saw a notable 8% tumble in Amazon shares after their cloud sales results. Kind of disappointed.
Yeah, quite the sell-off. And what's fascinating here is how the market immediately reacted to that uncertainty. We saw a really clear flight to safe haven assets, the places investors typically park money during volatile times. Gold, for instance, spiked over 2% to a one-week high. U.S. Treasury bonds rallied. But interestingly, Bitcoin, despite all this, it's been quite resilient. It was hovering around $114,600. That suggests that, while equity markets pulled back, the risk appetite in the crypto space might remain surprisingly intact.
Interesting contrast.
Meanwhile, oil prices, they extended their slide. WTI crude, that's a key benchmark, trading near $67 a barrel.
Okay, so beyond those raw market numbers, the weekend also delivered a few, let's say, major macro surprises that are probably going to shape the week ahead. Let's start with the oil markets. OPEC and its allies, OPEC Plus, they confirmed another large output boost. They agreed to raise oil production by 547,000 barrels per day, starting in September.
Right. And this raises a really important question for you listening. I mean, on one hand, increased supply could help temper oil prices, which, is good for consumers, helps ease inflation pressure. But on the other hand, it reflects OPEC's sort of surprising confidence in future demand, even as concerns about U.S. economic growth are clearly mounting. So for energy stocks, this could mean headwinds if oil stays subdued.
Yeah, a real double-edged sword there. And speaking of disruptions, a political tremor then shook trust in a different kind of market foundation. The integrity of economic data. On Sunday, top White House officials defended President Donald Trump's abrupt firing of the Bureau of Labor Statistics Commissioner Erica McIntyre. Trump accused her of faking employment numbers without evidence, mind you, after the latest report revealed 258,000 fewer jobs were created in May and June than they previously thought.
Exactly. And what's truly insightful about this, it isn't just the firing itself, it's what it signals. This incident highlights a growing politicization of foundational economic data. It forces investors like you to grapple with this, frankly, unprecedented level of uncertainty when interpreting official figures. As one market economist put it, and I thought this was telling, I don't like to see a bureaucrat fired just because the data that does to support the administration's policies. It's a reminder that even data isn't immune to political turbulence, and reliable numbers are absolutely crucial for things like, the Fed's policy expectations and just broader investor confidence. So the question is this just political noise? Or does it fundamentally change how investors are going to approach future employment reports? Well, it definitely adds a new layer of skepticism, I think. It suggests that moving forward, investors might have to factor in potential political interference when they're evaluating official economic releases. And that just makes the job of predicting market reactions and even the Fed's next moves significantly more complex.
Yeah, another layer of uncertainty. Okay, finally, shifting gears to trade. U.S. Trade Representative Jamieson Greer signaled on Sunday that the latest round of tariffs on U.S. trading partners are, quote, pretty much set and unlikely to be rolled back anytime soon. These tariffs, they range from 10% to 41% on imports from 68 countries plus the EU, and they're set to take effect August 7th.
Right. And if we connect this to the bigger picture, this hardline stance suggests trade tensions aren't going away. They remain a significant downside risk. Beyond the immediate higher import costs, which could squeeze corporate margins and consumer prices, these tariffs signal a sort of deep-seated commitment to economic nationalism. This could mean a longer-term reshuffling of global supply chains, maybe a potential reevaluation of international trade as a growth driver, and we're already seeing geopolitical frictions flare up. Notably, India signaled it will keep buying Russian oil despite Trump's tariff threats.
So pulling it all together, what does this mean for you looking ahead this week, especially given everything we've just discussed?
Well, investors will be closely watching a cluster of economic reports this week. On Tuesday, August 5th, for example, keep an eye on the July ISM non-manufacturing PMI. That's a key indicator measuring the health of the crucial services sector, the largest part of the U.S. economy. A strong upside surprise there could diminish market hopes for Fed rate cuts. Whereas, a significant miss would amplify those concerns of a broader slowdown and likely bolster the case for Fed easing, meaning rate cuts to stimulate the economy.
Okay, so that PMI number on Tuesday is pretty key then.
Very key.
It sounds like the overall market outlook is, well, quite mixed, a real tug of war, like you said, between hopes for Fed help and fears of the economy faltering.
Absolutely. Caution is warranted right now. We expect pretty choppy trading ahead as the market digests all these cross-currents. For you, this probably means a defensive stance with prudent risk management is advisable. Think through diversification, maybe protecting your portfolio against risk through hedging, and definitely avoiding excessive debt or over-leveraging. Stay alert for potential relief rallies if we get positive surprises, but also be prepared for further downside if the macro news disappoints. Really, the next 24-48 hours will be critical in shaping the market's next move.
All right. A final provocative thought then for you to mull over. How might this interplay between economic data, political decisions, and central bank actions shape your own financial decisions and planning in what feels like a pretty uncertain and volatile environment? Enjoy the brief? Please like and subscribe. From equities and bonds to global risk sentiment, we deliver days key market moves, macro trends, and institutional flows in just 5 minutes. Live stream coming soon. Stay tuned.